Good day, students. In this lesson we are going to be talking about the tax matters of a company. A wise old philosopher said more than 2,000 years ago, there are only two things in life that are certain, and those are death and taxes. So let us rather not talk about death, let us rather talk about taxes. Over the last few years, the tax authorities in South Africa, which is known as the South African Revenue Service, has tried to simplify company income tax or business tax by introducing various kinds of simpler taxes such as turnover tax, etc. However, we are going to be focusing on a larger company, so a company that is not a small to medium-sized enterprise, that does not have turnover tax, but that is actually being subjected to full-on income tax. Before we get to that, let's maybe just talk about the various kinds of taxes that a company has to deal with. We'll also see that some of those taxes the company only needs to administrate. It is not actually levied on the company. So the first type of tax that a company has to deal with is value-added tax or VAT. Now VAT you have covered in Financial Accounting 1. You already know from Financial Accounting 1 that value-added tax is not imposed on the company that levies it, it is imposed on the consumer that purchases from that company. So it is not a tax that is levied on the company, but the company acts as an agent on behalf of the Revenue Service to collect the value-added tax from the consumers, in other words their customers, and then pay it over on behalf of the consumers to the Revenue Service. In the case of employees tax is also not a tax imposed on the company, it is a tax imposed on the employees of the company. But again, the company has got the duty to do the administration around employees tax. So the company must withhold the tax portion of the salary or the wage that is going to be paid over to the employee, and then pay over that tax part over to the Revenue Service on behalf of the employee. That is known as the pay-as-you-earn system, or PAYE. In the case of where we have a liability to pay over the PAYE to the Revenue Service, we create a liability account called Current Tax Payable :PAYE, which stands for Pay As You Earn, as we've just said. Where we have a liability to pay over value-added tax on behalf of the consumers to the Revenue Service, we create a liability account called Current Tax Payable Value-Added Tax. Then the company also has to deal with the administration of dividends tax. Dividends tax is a tax levied on the dividends that a company declares, but the dividends tax is actually not levied on the company. It is levied on the shareholders of the company. But again, the company has got the duty or responsibility to do the administration. Like employees tax, it's a withholdings tax. So the company has the duty to withhold the tax portion from the total dividend that it has declared, and then pay over the net amount to the shareholders, and the tax part, the dividends tax part, to the Revenue Service. And then we get to income tax. Income tax is actually a tax that is imposed on the company. So the first three kinds of taxes that we mentioned, that we've been talking about, are taxes that the company has to do the administration for, but it's not levied on the company. So if it's not levied on the company, it means it is not an expense to the company either. In the case of income tax, which is levied on the company, that means it will be an expense to the company. In our first term, when we spoke about IAS 1, the disclosure requirements, we've already seen that the income tax expense is a disclosable item. It has to be disclosed on the face of your statement of comprehensive income, after profit before tax, and just before your profit for the period or profit for the year. Also, please bear in mind, when we spoke about IAS 1 in the first term, when we spoke about the disclosure requirements, we said that the amounts owing for various or different kinds of taxes must be disclosed separately in our current liabilities section of our statement of financial position. It deals with offsetting. As you can see in the slide, you remember we said that in the case of the South African Revenue Service, and I guess most revenue services around the world, you cannot simply pay them the net amount, or they cannot simply pay you the net amount. Their administration and account system works in such a way that the full amount receivable or the full amount payable in respect of any kind of tax must be settled. So, for instance, if they owe you 20,000 rands worth of value-added tax and you owe them 40,000 rands worth of income tax, you cannot simply go and pay them 20,000 rands and then believe that the difference is now settled. They don't owe you anything, you don't owe them anything. The revenue service system works in such a way that if they owe you 20,000 rands in value-added tax, they have to pay you that 20,000 rands in value-added tax. And if you owe them, let's say 40,000 rands in income tax or employees tax or any other kind of tax, you have to pay the full amount. So you cannot offset the two and just pay the difference. So how do we calculate the income tax expense and how do we record it? In this particular course in Financial Accounting 2, we are going to stick to the standard rate or the prescribed rate of income tax prescribed by the Income Tax Act for a South African company for the last few years, which is currently at 28%. We can just mention perhaps a long time ago, many years ago, that income tax rate was actually 50%. But that is the bad old days, a long time ago. In more recent years, it was 30%, so perhaps you'll find some older textbooks which still uses the tax rate of 30%. Then it was decreased to 29%, but for the last number of years, it is 28%. So how do we calculate our current income tax expense? It is our taxable income or taxable profit, which we will discuss in a later slide, multiplied by the applicable tax rate. And as we've said, the tax rate applicable at this stage, in accordance with the Income Tax Act, is 28%. Very important to note is that the taxable income or the taxable profit is not the same as the accounting profit. We'll see a little bit later in this same class what the differences are between your taxable profit or taxable income and the accounting profit. Perhaps this is also a good time to understand now when we refer to an accounting profit, it is that line item on the face of your statement of comprehensive income that reads profit before tax. So the profit before tax represents your accounting profit. And we are going to use that accounting profit, the profit before tax, as the basis of our tax calculation. So later on in this class, when we are going to do the tax calculation, and even later in this class when we are going to be doing our income expense note, you will see that the profit before tax is basically a point of departure. So once we have calculated our income tax expense, how do we record it? We know that expenses will be debited, so we are going to debit the account that we call income tax expense. And at the same time, we are going to raise the liability towards the relevant revenue service. So if we are in the United States, for instance, the revenue service that we will be dealing with is the IRS, the Internal Revenue Service. If we are in South Africa, and that is what we are going to continue focusing on, our revenue service is called the South African Revenue Service, or SARS. So we're going to raise a liability towards them. What are we going to call that account? We're going to call it current tax payable, which indicates the liability, colon or dot dot, which kind of tax? Income tax. Remember, for each liability towards a different kind of tax, we're going to disclose that separately on the face of our statement of financial position under current liabilities. Therefore, we need a different account for each of them. So how do we calculate taxable income, or also known as taxable profit? Here we must understand that when we draw up our financial statements, we draw up the financial statements in accordance with the IFRS, the IFRS, the International Financial Reporting Standards. Those are standards that are relevant to many countries, most countries in the world. However, each country has its own tax legislation. So in our country, South Africa, we have the Income Tax Act. Most other countries, in fact probably all other countries, will have their own kind of Income Tax Act. So even though the IFRS, the International Financial Reporting Standards, are universal, it's used all over the world, each country, each specific tax domain has got its own tax legislation. So therefore we have to convert the accounting profit, which is on the face of our statement of comprehensive income, which we call our profit before tax, which has been calculated using the IFRS. We have to convert that into a taxable profit, which is then calculated in terms of the country's tax legislation where that country is situated. Now, when it comes to the differences between the accounting profit and the taxable profit, we can basically distinguish between two kinds of categories. The first category being temporary differences. In other words, it's a difference, as we'll just briefly mention later again, a difference between the accounting treatment and the tax treatment, but it is only a difference for a period of time. After a specific period of time, it sorts itself out. And then we have permanent differences. Permanent differences means never in the future will an amount that is not taxable now be taxable, and never in the future will an amount which is not deductible for tax purposes now be deductible. All right, so the temporary differences we are going to be dealing with in Financial Accounting 3. There we have a specific topic called deferred tax. Sorry, it took me a little while to get to the name of the topic. There we have a topic called deferred tax. Deferred meaning you are postponing the tax. So deferred tax, that will be dealt with in Financial Accounting 3, but permanent differences we are going to be dealing with now in Financial Accounting 2. To summarize, we are going to start with our profit before tax, which is our accounting profit, and then we will adjust it with all the permanent differences between the accounting treatment and the tax treatment, and that will then provide us with a taxable income or the taxable profit. We apply the applicable tax rate, 28%, to that taxable profit, and that then produces the income tax expense for the year. We have mentioned what the entry will look like, and also do not forget that this is a cost to the company, so therefore it will be disclosed as an expense in our statement of comprehensive income. In the case of deferred tax, that will be dealt with in Financial Accounting 3. So just bear in mind when you are doing the topic of deferred tax, you will be dealing with the temporary differences, or also sometimes known as the non-permanent differences, or sometimes also known as timing differences. but for financial accounting too, you can ignore that. So let us talk about the permanent differences. We can basically distinguish between two kinds of permanent differences. Remember, when we say it's a permanent difference, it means that the taxation treatment of the income or expense and the accounting treatment is different, but it will always stay different. So when it comes to permanent differences, the two kinds of permanent differences that we can get is, first of all, exempt income. Exempt income is a type of income that we have recognized for accounting purposes, so it is part of our statement of comprehensive income, but it will never be taxable. The second kind of permanent difference that we can identify is what we refer to as non-deductible expenses. So those are expenses that are included in your cost functions in your statement of comprehensive income. So for accounting purposes, those expenses have already been deducted in arriving at the profit before tax, but they are not deductible for tax purposes. Here we can see a typical tax calculation. So we said we are going to start with our accounting profit. So our accounting profit is what we have disclosed on the face of our statement of comprehensive income as our profit before tax. Then we are going to adjust it with the various kinds of permanent differences. For instance, exempt income, what we must remember here is that that income has already been recognized in arriving at the profit before tax, but it is not taxable. So therefore we have to take it out of our profit before tax, out of our accounting profit, in order to arrive at the taxable profit, right? For instance, let's say dividend income. In the case of dividend income, that has already been subjected to dividends tax before we even receive it. The company that we receive the dividends tax from would have withheld that tax portion, so we are only getting the net amount. There are all sorts of rules in the Income Tax Act to prevent double taxation, so the fact that the dividend income has already been subject to a kind of tax, which is dividends tax, means that it is now exempt for income tax purposes. But you remember that dividend income is part of your revenue. So being part of your revenue, it is already included in your profit before tax calculation. However, it is not taxable, so therefore we are allowed to take it out of the profit before tax to calculate the taxable profit for the year. Then we can have non-deductible expenses. That would also be a permanent difference. A typical non-deductible expense would be fines. Clearly, if you are slapped a fine, you are being slapped on the wrist, you did something naughty, now you cannot use that fine that you have paid, a traffic fine or a fine for the late submission of your tax return, to then use it as a tax deduction. So the fact is, you have actually paid the fine is an expense. So that fine would have been deducted in arriving at your profit before tax. It is a real accounting expense, but you are not allowed to deduct it for tax purposes, which means you now have to add it back. Another kind of non-deductible expense is a donation. Donations, why it's not a deductible expense is it can be abused. People can, let's say, pay their son or their daughter's student fees from their company account and then say, well, it's a donation, I'm going to deduct it for tax purposes. So that cannot be allowed. We must just mention that the Income Tax Act does provide for certain donations to be deductible. But the institution who receives the donations must apply to the Commissioner for Internal Revenue for that to be deductible. So a donation that is made by default will not be a deductible expense. It will be a non-deductible expense. The exception being if that specific organization who receives the donation has applied to the Inland Revenue, the Department of Finance, for people who make donations to them to deduct that for tax purposes. The Nelson Mandela Children's Fund is a typical example where donations to that fund will be deductible in the hands of the person or institution making the donation. But for our purposes, remember, by default, a donation is not deductible. We also need a specific note that is going to describe and provide more details to the users of the financial statements about the income tax expense. So there will be a supporting note. We're going to call it the income tax expense note, and this note consists of two sections. The first section basically explains to the user of the financial statements what is included in the current year's income tax expense. What is included there? Is it only the current tax for the current year? Does it include an increase in deferred tax, which we'll only deal with in Financial Accounting 3? Does it also include perhaps an amount that we did not provide enough for last year or in a previous year that we now had to provide for in this year? So the top section deals with how is the income tax expense made up of. The bottom section, the second section, tells the reader how did we calculate that income tax expense and why does it differ? Why does the effective tax rate differ from the applicable tax rate? In effect, that bottom section with one or two exceptions is going to be our tax calculation in a slightly different guise. In our tax calculation, you'll remember we used the gross amounts. We started with the profit before tax, the gross profit before tax. Then we adjusted it for permanent differences. So we would have deducted exempt income. We would have added back any non-deductible expenses. But in the case of the note, we are going to repeat that calculation, but we are not going to show the gross amounts. We're going to show the tax effects of those amounts. In other words, we're going to apply the applicable tax rate to those gross amounts before we disclose it in the note. When we cover the note, you'll see there is one exception, and that is an overall under provision, which was not originally part of our tax calculation. That needs to be disclosed as part of that second or bottom section. So let us get to our first example. Here we have example 1. Our company is called X Limited. It has a financial year end on the 31st of December. We are in the 2020 financial year. X Limited had a profit before tax. Again, remember, that is our accounting profit. That is the accounting profit that is disclosed on the face of our statement of comprehensive income for that year ended the 31st of December 2020, and it amounted to 830,000 rands. Then we can see that that profit before tax, the accounting profit, included an exempt capital profit of 150,000 rands. We'll talk about capital profits and capital gains tax in a different class, a class that will follow on this one. The fact is, here we can see that the capital profit is exempt. In other words, it's not taxable. It is included in our profit before tax, but we can exclude it for tax purposes. We also see that the company received dividends. They had dividend income on listed shares that they invested in, and that dividend income amounted to 50,000 rands. Now, as we've said earlier, we already know that the dividend income would have been subject to dividends tax. So therefore, to prevent double taxation, it is not going to be subject to income tax again. Right? So that is clearly an example of exempt income. The company also made donations to various charities of 40,000 rands. Like we said, the default is that it is not going to be deductible. It's only in those few instances where special authorization has been received from the Revenue Service for it to be deductible that it is deductible. So we can assume if nothing is mentioned about special arrangements, then it will be non-deductible. And then fines paid. They paid traffic fines, or they paid fines on the late submission of their tax return, or an underpayment of their provisional tax, that amounted to 30,000 rands. And as we've said, the whole purpose of a fine is to give you a slap on the wrist, so it's to punish you, so you cannot use that punishment now as a benefit for tax purposes. So what is required of us? Firstly, to calculate for the year ended the 31st of December 2020, the taxable accounting profit as well as the current tax expense. We must provide the journal entry to record the current tax expense, and then we must provide an extract from the Statement of Comprehensive Income. Clearly that will have to do with something with our income tax expense. We can simply start with the profit before tax figure, and then we need the income tax expense note. So here we start with the solution. First of all, the calculation of the taxable income or taxable profit, as well as our income tax expense. Now, as we've mentioned in a previous slide, we're going to start with our accounting profit, which is disclosed as the profit before tax on our Statement of Comprehensive Income. We saw in the question that amounted to 830,000 rands. Then we have the exempt capital profit of 150,000 rands. As we've mentioned in the example, not the example, but in the discussion previously, the capital profit is already included in your profit before tax, but it is not taxable. So in order to calculate the taxable part of your profit, it means you can now take that exempt capital profit out, which means you have to deduct it from the profit before tax. We also have dividends, dividend income, the dividends that we have received of 50,000 rands. Remember, that is part of our revenue. Dividend income is part of our revenue, so it's already included in the profit before tax. But luckily for us, we are not going to pay income tax on it again. We've already paid dividends tax on it. So therefore, in order to arrive at our taxable profit, we can now take it out of the profit before tax, which means we deduct it, so we can say less the 50,000 rands. In the case of the donations, which is not a deductible expense, we must remember that we have made the donations. So it is an expense for us. So in arriving at the profit before tax figure, the donations expense has already been deducted. But now we are not allowed to deduct it for tax purposes, which means we have to add it back to the profit before tax figure before we arrive at our taxable income. So that is why we add it back. In the case of the fines, very similar to the donations, the fines were expenses of the company. So we have paid those fines. They have been included in the expenses in our Statement of Comprehensive Income. So they have been taken into account in arriving at profit before tax. But we are not allowed to deduct it for tax purposes. So therefore we've got to add it back to our profit before tax figure in arriving at the taxable profit figure. Once we've calculated the taxable profit, then we apply the applicable tax rate as prescribed by the Income Tax Act, which is currently 28%. So we take the 700,000 rands, which is our taxable profit, multiplied by 28% gives us an income tax expense of 196,000 rands. How are we going to journalize it? Well, we know the income tax expense is an expense, so that will have to be debited. The expense we've just calculated is 196,000 rands. At the same time, we've got to raise the liability towards the revenue service. Therefore, we're going to credit current tax payable, which is an indication of a liability, colon, dot, dot, which kind of tax? Income tax. We also need to provide an extract of the statement of comprehensive income. We are allowed to start with profit before tax. We know that we have the profit before tax figure that was provided to us. Now we deduct the income tax expense. Don't forget, it's an income tax expense. It's not income tax paid. It's not income tax payable. Income tax paid represents a cash flow. Income tax payable represents a liability. So this is not a liability. It's not a cash flow. It is an accrued expense which relates to our income tax. So we call it the income tax expense. Clearly, it must be shown as a negative. Then we draw a line and we have a subtotal called profit for the period, or if it's for a full financial year, we can also call that profit for the year. Our income tax expense note. The first part of the note, we have said we're going to indicate, disclose what is included in the expense. So here we can see in our income tax expense note, current income tax, right, as opposed to deferred income tax. Current tax for the current year, for this year that we are reporting on, was an expense of 196,000 rands. There was no under provision or over provision for the prior year. We'll discuss that a little bit later in some slides that will follow this. And then we have a subtotal for the income tax of 196,000, and then the deferred tax, which again, when you are dealing with financial accounting 2, will not come into play. The deferred tax will only come into play when we are doing financial accounting 3. And then we add that all up and we have a total which we describe as the income tax expense per the statement of comprehensive income. So that is the top part of the note. In the bottom part, we are going to do a rate reconciliation. So please, we'll have to have a little subheading there, rate reconciliation. And then we start the second part of the note with what is the rate that is prescribed by the Income Tax Act for that company for that financial year. So we describe that as the applicable tax rate. Please do not just write tax rate. Write the applicable tax rate, and then we disclose the percentage. Also, ladies and gentlemen, students, do not indicate that 28% right next to the words applicable tax rate. Remember, you've got a column for the current year. You've got another column for your comparative figures. So that 28% will be indicated in the column for this current year. Then we have another little subheading, the tax effects of. And then with one exception, we are going to repeat our tax calculation. And as we've said, we are not going to use the gross figures as we did in our tax calculation. We are going to show the net figures. So the net figures after we have applied the applicable tax rate, that represents what we call the tax effects. So where did we start our tax calculation? We started with our accounting profit, which is disclosed on the face of our statement of comprehensive income as the profit before tax. We know that profit before tax was 830,000 rands. Now we apply the applicable tax rate of 28%. So that gives us 232,400 rands. So if there had been no permanent differences between our accounting profit and our taxable profit, that means our income tax expense for the year would have been 232,400 rands. But it isn't. It is 196,000 rands. Why? Because of those differences in treatment for accounting purposes and income tax purposes. So now we're going to explain it to the users in the second part of the note. So we saw that we had exempt income. The exempt income was 150,000 rands in the case of the capital profit, but we do not show the gross figure, we show the tax effect, in other words the net figure. So we apply the 28% to the 150,000 rands, and then the tax effect of that exempt capital profit of 150,000 is actually a minus 42,000. In the case of the dividend income, we had dividend income of 50,000 rands. That was applied and used in our tax calculation, but in this note we show the tax effect. In other words, we apply the applicable tax rate first. So we've got the dividends, the dividend income of 50,000 rands. We apply the 28% applicable tax rate. That gives us a tax effect of 14,000 rands. And again, remember, in our tax calculation we deducted that, so we also deducted here in the note. Why do we deduct it? I know I'm repeating what I've said earlier, but the reason is the dividend income would have been included in the profit before tax, but it is not taxable. So we, for our benefit, lucky us, we can now deduct it from the profit before tax before we apply the applicable tax rate. We had donations that we've paid, a donation expense of 40,000 rands. We used that in our tax calculation. So again, we are going to show it in this second part of the note, but remember, we're not showing the gross amounts, we are showing the tax effect. So we're going to apply the 28% applicable tax rate before we disclose the amount. So it's 40,000 rands worth of donations multiplied by the 28% applicable tax rate gives us a tax effect of 11,200 rand. But now we've got to add it back. Remember, we have already deducted that in arriving at our profit before tax, but we are not allowed to deduct it for tax purposes, so we have to add it back. The same applies to the fines. We've paid fines of 30,000 rands. We've already deducted that for accounting purposes, but we are not allowed to deduct it for tax purposes, so we've got to add it back. Again, in this note, we're not showing the gross amount, we're showing the net amount, which is the tax effect. So we take the fines paid of 30,000 rands multiplied by the applicable tax rate of 28%, which gives us 8,400 rands that we've got to add back to our accounting profit to arrive at the taxable profit, but here we only use the tax effect. Again, that should provide us with the income tax expense as per our statement of comprehensive income, and clearly that 196,000 rands must agree with the total you have in the first part of this note, which was also 196,000 rands, and obviously, students, that must agree with the figure that you are disclosing on the face of your statement of comprehensive income as an income tax expense. Right, and then last part of this note is the calculation of the effective tax rate. We know that the applicable tax rate is 28%, but because of the exempt income and because of the non-deductible expenses, in other words, the permanent differences between the accounting treatment and the tax treatment, our effective tax rate can be more or less than the effective, than the applicable tax rate. So how do we calculate the effective tax rate? Clearly, we cannot start with the 232,000. That is the amount of the applicable tax rate applied to our profit before tax. So here we've got to take the actual income tax expense that we have disclosed on the face of our statement of comprehensive income. So in other words, the total of the first part of this note and also the total of the second part of the note, which is 196,000 rands. And we've got to divide that by the profit before tax, the amount that we have disclosed as profit before tax on the face of our statement of comprehensive income, and then we express that as a percentage. In this case, we see that the percentage comes to 23.61%, so it is less than the applicable tax rate. Why? Well, mostly because there was a lot of exempt income. The reason behind this part of the note, if we can just summarize, remember, if we did not have this note, then the user of the financial statements will see on the face of their statement of comprehensive income profit before tax of 830,000 rands, and then just after that, the next line, it will say the income tax expense was 196,000 rands. Now, if they take that 196,000 rands and they divide it by the 232,000 rands, they'll see, whoa, this company paid income tax at a rate of 23.6%. Why? Have they defrauded the revenue service? Have they made a mistake? Why is it not 28%? And this part of the note explains to the user of the financial statements why the effective tax rate is not 28%, why it is less than 28%. Well, it's due to mainly the exempt income of the capital profit that the company has generated, also the dividends, the exempt dividend that they've received. Obviously, the non-deductible expenses would increase the effective tax rate, but that is a lot lower in aggregate than the exempt income. Just to summarize the note, the current tax for the prior year and the underprovided for the prior year, there was no underprovision in this particular example. We are going to look at such an example a little bit later in this same class. Also remember that when it comes to the disclosure of deferred income tax, that is a financial accounting 3 topic. This slide is just a reminder that you must read the question properly. What is required of you? Do you need to provide the whole note, or just the first part, or just the second part? Also that temporary differences, which deals with deferred tax, is only dealt with at financial accounting 3 level. And when it comes to your rounding, especially when it comes to the effective tax rate, please round it off to 2 decimals. During this slide, you can just sit back and listen carefully. In the slides that follow, we will explain it in more detail, but here we just want to tell you the overall story. That deals with the so-called tax cycle of a company. The tax cycle of a company is determined by the Income Tax Act. Now, what does the Income Tax Act require of a company when it comes to their income tax? First of all, it requires the company to pay their income tax for that current year in which they are in advance. What the Income Tax Act requires is that the company must make a first provisional tax payment on or before the last day of the first 6 months of their financial year. So, if the company's financial year ends on the 31st of December, it means that on or before the 30th of June of that year, they must make their first provisional tax payment. How we are going to calculate that, we will discuss a little bit later in this class. Secondly, the Income Tax Act then stipulates that on or before the last day of the company's financial year, they must make a second provisional tax payment. So if the company's financial year ends on the 31st of December, then it means on or before the 31st of December, they must make the second provisional tax payment. If they fail to make the provisional tax payment, they will get a fine on it. I think the fine is 10% on the amount that they should pay. Right, so those are the first two requirements. Then, when it comes to the end of the year, the company has to draw up their financial statements. In order to draw up the financial statements, we need to have our records up to date, right? So the company will obviously draw up the financial statements after the end of the financial year. So if the financial year end is the 31st of December, they will only start drawing up the financial statements somewhere in January, late January, because remember there are all sorts of closing entries that needs to be done. You need to calculate your provision for bad debts. You've got to calculate the depreciation and amortization and all sorts of things. But anyway, the fact is, when you draw up your financial statements for that year ended the 31st of December, you are physically in January. So you draw up your statement of comprehensive income. So you start with your revenue, you've got your other income, then you've got your cost of sales, you've got all your various cost functions, then you've got your finance costs, then you draw a line and you have a subtotal that you call profit before tax, and then you have your next line item, which is your income tax expense, and then you say, oops, what is my income tax expense? I now have to go and make a calculation. I have to go and estimate what I, as the accountant of the company, believe my income tax expense for this year is going to be. Okay, so we have to estimate the taxable profit. And then we apply the applicable tax rate to that taxable profit, and then we calculate our income tax expense. So at least now we've got a figure that we can use in our statement of comprehensive income, and we can carry on, and then we can have our profit for the period or profit for the year, and so on. We can carry on. But now we've got a little bit of a catch-22 situation here. The Revenue Service uses our financial statements to calculate what our actual tax expense for the year is going to be. But we haven't submitted our financial statements yet. So we've got to complete the financial statement first. Then we've got to complete our income tax return and ITR 14, and then we have to submit it to the Revenue Service. Once the Revenue Service has done an assessment of that, an assessment is almost like a little audit. They are going to check your facts. They're going to see whether the figures that you've included in your income tax return agree with the figures on your financial statements and so forth. Then they are going to tell you what they believe. The Revenue Service is going to tell you what they believe your income tax expense for that year should have been. So they might disagree with some of the expenses that you have regarded as deductible, or they might disagree with you with some of the income that you have regarded as non-taxable or exempt. So there might be a difference of opinion. In real life, the tax assessment that they send you, you can actually object against it. They can then not accept your objection, and you can appeal against their rejection of your objection. It's a long story, but to cut that long story short, we, for financial accounting 2 purposes, will assume that the Revenue Service is correct and that we have made a mistake. So once they provide us with that document in which they tell us what they believe our income tax expense should be, we accept that they are right and we were wrong. That means at that point in time, if there is a difference, we've got to go and adjust our income tax expense for the previous year. However, there is a slight little bit of a itsy-bitsy problem here, in the sense that we have already drawn up our financial statements. We've already closed off our accounts. So we cannot go and climb into a time capsule, go back in time and change it. We have to make those changes in this year's financial statements, but it relates to last year's income tax expense. Once we have adjusted our income tax expense and our income tax current tax payable, the liability account, either for an under provision or over provision, which we will be discussing fairly soon during this class, then whatever remains, whatever balance remains on the liability account, the income tax payable or current tax payable colon income tax, I should say, that will represent the amount that is owing between the two parties. Once we've made that adjustment for the overall or under provision, and we have a credit balance on that account, it means we owe money to the revenue service. Once we've made that adjustment and we have a debit balance on that account, it means they owe us money, right? So then it is actually income tax refundable. So that is the tax cycle. So once you understand the tax cycle, I think the rest of the examples and the explanations that we are going to be doing will be very evident and will be clear. So right, let's just summarize. First of all, we have to make a first provisional tax payment on or before the last day of the first 6 months of the year. So that is an amount that we are paying in advance. It's not an expense yet. We are paying the expense for the year in advance, but we do not have an expense until the year is over, and we're only halfway through the year now. Then at the end of the year, on or before the last day of the financial year, we've got to make a second provisional tax payment. Again, remember the year for our purposes is not over yet because we haven't drawn up the financial statement. So again, we are paying that tax expense in advance. It's not an expense yet. In fact, if it turns out the next year that we have no income tax expense, the revenue service will have to refund us that amount. So we are basically creating a debtor, a prepaid expense, which is in our current tax payable or current tax receivable income tax account. Once we at the end of the year and we do all our closing entries, we do our depreciation calculations and so forth, and we can complete the financial statements, we have to estimate what we as the accountant of the company believe the income tax expense will be so that we can complete the statement of comprehensive income. Then we submit the statement of comprehensive income together with all the other financial statements for that year, together with our tax return for that year to the revenue service. And once they have had a time, takes a little while, once they've done their assessment of what we have submitted, they will send us what we call a tax assessment, which is a document that tells us what they believe our tax expense for that year should have been. And if there's a difference between our calculation and their calculation, we then adjust our current tax payable account if we believe we have made the mistake, which for our purposes is what we will believe. And then the final step of that whole cycle is where we then either pay the amount that we owe to the revenue service or they refund us the amount that they owe to us. End of story, end of that tax year, and then the cycle starts all over. So for this new year that we are in, we have to again pay a first provisional tax payment before the last day, on or before the last day of the first 6 months of the year, and so on and so on and so on. So it's a cycle that repeats itself. Okay, so now let's go and look at the detail. Now that you have listened to the story about the tax cycle of a company, let's get into the details. We've spoken about the tax assessment. That is where the revenue service, based on their calculations, tell you whether your estimate of the income tax expense according to these financial statements that you've submitted will be in agreement with what they have calculated. When it comes to the tax assessment, once you've received that, as we've seen earlier, now you have to judge whether you have over-provided for tax in the prior year. In other words, have you provided too much tax? That means if you have provided too much tax last year, you now have to decrease the tax provision in this year, but it relates to the previous year. or if you have provided too little tax last year, which means you've underprovided for tax in the prior year, you'll also have to make an adjustment both to the liability as well as to the expense. If you have provided too little tax, it means you have to provide more tax now. Too little last year, so we have to provide a little bit more tax now. But remember, you are providing it in this year, but it relates to last year, the prior year. As we've mentioned earlier, you must remember that once you've completed the financial statements, once you've submitted them to the receiver of or the revenue service, then you've closed off your books. You cannot go back and change the financial statements. You can only make those adjustments in the current year's books of account. Right, even though they relate to last year, you can only do it in this year's financial statements and financial records. So when there's an over or an under provision, what would the typical journal entries look like? If you have provided too little tax, if the taxman tells you, if the revenue service comes back and say you have provided too little income tax expense, it means you now have to go and provide more income tax expense, which means that you've got to increase your expense. So you'll have to debit the income tax expense again, which at the same time means you owe them a little bit more than you originally thought you would owe them. So you have to go and increase your liability to them as well. So you have to go and increase the current tax payable income tax account. If you were in a situation where you provided too much tax, too much income tax expense last year, it means you have over-provided in the previous year. So that means to adjust that, to correct it in this financial year, you've got to decrease your expense. You've already provided too much expense last year. So therefore, you have to do the opposite to what you did when you provided for the income tax expense. Now, instead of debiting the income tax expense, in other words, increasing it, you've got to decrease it, which means you now have to go and credit the income tax expense to decrease that account. At the same time, we now owe less to the revenue service than we originally thought at the end of last year when we provided for our income tax expense, which means that our liability will be less than we originally envisaged. So therefore, we've got to debit the liability. The liability account is our current tax payable income tax account. We now owe them less than we thought. So we go and debit that account. We have mentioned the second provisional tax payment. If we have made an underpayment and we have to go and make a top-up payment in the following year, that is very often called a third tax payment, but there is no term in the Income Tax Act that actually calls it a third tax payment. There is no such a thing as a third provisional tax payment. The better term to use is a top-up payment. So here we are now at the second example. Here we've got an example that basically covers 2 tax years. It covers the tax cycle for 2 tax years. So let's have a look. Our company is X Limited and their financial year end is the 31st of December. Then we've got 2 tax years or years of assessment. The 2019 and 2020 years of assessment. So we see on the 30th of June, and remember this company has got a year end of the 31st of December, so a first provisional tax payment has to be made on or before the last day of the first 6 months of their financial year. And so they cannot make that payment later than the 30th of June, then they will be fined. They'll get a penalty, right? So it's got to be before or on. So in this case, they just made the margin. They are doing it on the very last day that they are allowed to, which is the last day of the first 6 months of the financial year. So on the 30th of June, they made their first provisional tax payment amounting to 30,000 rands. Then again, just in the nick of time, on the 31st of December, they made their second provisional tax payment of 40,000 rands. On that same date, they provided for an income tax expense, and we can see that the taxable profit was 260,000 rands and the tax rate was 28,000 rands. This question doesn't provide us the amount. We've got to go and calculate that. As we've said earlier, in practice, you will do this provision in January of 2020 or late January, or even early February, when you've done all your final year-end entries and your calculations of depreciation and so forth. But you can still, your accounts haven't closed. You haven't closed off your accounts for the year yet, so you can still date it at the 31st of December of 2019. In other words, in our financial year that we are drawing up financial statements for now. Then we see in the next year, on the 15th of February, the amount still due to the South African Revenue Service regarding the income tax for last year, 2019, was paid. How much? Don't know. We'll have to find out when we do this question. Then, in that 2020 year, on the 30th of June, we made our first provisional payment for the 2020 financial year. Remember, it has to be done before or on the 30th of June because our financial year end is the 31st of December. And then again, they cut it very finely by then paying on the very last day of December. The fact it must be before or on the last day of the financial year, they must pay their second provisional tax payment. And here we can see that provision for the income tax expense was made. The calculation was made for the taxable profit of 320,000 rands, and the applicable tax rate was 28,000 rands. We must just go and calculate what the actual expense is. Then we've got additional information here. They say on the 30th of January 2020, the tax assessment was received from SARS. Right, so if we received it on the 30th of January 2020, it means it relates to the previous year. So that relates to the 2019 year of assessment. And they say there the assessed tax, not taxable income, tax. Bear in mind, the assessed tax, their calculation, SARS's calculation for the 2019 tax year was 78,800. Okay, so we will have to compare that with our calculation to see whether there was an over or an under provision. What else must we do? We must show the following accounts for the period 1st of January 2019 till the 31st of December 2020. That seems like 2 years to me. For the current tax payable income tax account and the income tax expense account. And then we also need to provide the income tax expense note for the year ended 31st of December 2020. In this case, we only need to provide the 2020 year, but we might also, it's quite easy to also provide the comparative figures for 2019. So let's start with the current tax payable income tax account. Now payable, as you already know, that indicates a liability, right? So this is not an expense, it's not an income, it is a liability. It could potentially also be an asset, right? If it's got a debit balance, it means the Revenue Service owes us. If it's got a credit balance, it means we owe them. Okay, so what happened? What was the first event that took place during that 2019 financial year? On the 31st of June, we made our first provisional tax payment of 30,000 rands. So, if we make a payment, which account do we credit? Bank account, right? Bank account, we know that. Now, we haven't incurred the expense yet because the year isn't over and done yet. We are paying this expense in advance. So for all practical purposes, we are creating a debtor here, an amount paid in advance. So we are going to debit our current tax payable income tax account with that 30,000 rands. Remember, students, this is a general ledger account. You do not provide a description, you provide the contra account. Which account did we credit? We credited bank. So therefore we indicate the account name bank. Right, so we debit current tax payable income tax with 30,000 rands and our contra account is bank. Then on the 31st of December, we made our second provisional tax payment of 40,000 rands. Again, we are making a payment. If we are making a payment, which account do we credit? Bank. Which account are we going to debit? The year isn't over. We haven't completed our financial statements yet. We are still paying this expense in advance. So we are going to debit current tax payable income tax with that 40,000 rands. And again, the contra account is bank. At the end of that year, right, we have to draw up our financial statement. So we are probably somewhere in January, and we have to draw up the statement of comprehensive income. Once we've disclosed profit before tax, we now know we've got to disclose an income tax expense. Right, that's a line item after that. So that means we have to go and suck a thumb. We have to go and estimate what we believe our income tax expense for the year is going to be. So how do we do that? We are going to first of all calculate what we believe our taxable profit to be. We have discussed that earlier. We're going to look at it later as well. We're going to start with our profit before tax. We're going to adjust it for permanent differences, being either exempt income or non-deductible expenses. If you are in financial accounting 3, you'll also consider temporary differences. Anyway, once we've calculated the taxable profit, in this case it was given to us as 260,000 rands, we apply the applicable tax rate of 28%. So we see that we estimate our income tax expense to be 72,800 rands. We have discussed the journal entry, so now we can see it here in our general ledger account. We are going to debit the expense, so we debit income tax expense by the 72,800 rands, and at the same time we now raise the liability. Remember when we paid that 30,000 and 40,000 provisional tax payments, it was an expense we paid in advance. But now that we have drawn up our financial statements, we have completed the financial statements, the expense has become real. Right, so now we've got to recognize the expense, and at the same time we've got to raise the liability. Right, so we recognize the expense by debiting income tax expense. We raise the liability by crediting the current tax payable income tax account. Okay, now we can complete our financial statements, which means we are going to close off our nominal accounts. We're going to balance off our so-called balance sheet accounts, so all accounts that deal with a statement of financial position. We balance this one off. We see that we have paid a total amount of 70,000 rands. We've provided for an income tax expense of 72,800, which means we are carrying forward a credit balance of 2,800 rands. Now, what happens in the next year, just after January, once we have submitted our financial statements to the Revenue Service, once we have submitted our income tax return, they assess it. Right, the Revenue Service assesses it. Once they've assessed it, which may take a few weeks, they will send us a document which is called a tax assessment. And they will tell us what they believe our tax expense should have been. And as we've seen in the question, they said our income tax expense, according to their calculations, should have been 78,800 rands. How much did we provide as an expense, 72,800 rands. So did we provide too much income tax expense last year? Did we provide just enough, or did we provide too little? Well, let's think about it again. We provided 72,800. They say we should have provided 78,800. So that means, according to them, and we have to accept that they're right, as we've said earlier, that means we've provided too little income tax expense. So how are we going to fix this? How are we going to correct the problem? The way we correct the problem is to provide a little bit more income tax expense. Again, we have got no time capsule. Even though that income tax expense relates to the prior year, last year, we can only fix it, we can only make the adjustment in this year's books. So because we've provided too little income tax, we've got to provide more income tax expense. That means, again, we have to go and debit the income tax expense account and then increase our liability towards the revenue service, which means we are going to credit the current tax payable income tax account. By how much? We provided 72,800. The revenue service says we should have provided 78,800, so we provided 6,000 rands too little, so we've got to provide an additional 6,000, right? So we're going to debit income tax expense by 6,000 and increase our liability by 6,000 rands. And then we've seen on, what was it, the 15th of February, the amount that was still outstanding between the parties was settled. So once we've made this adjustment, what is the balance on this account? Remember, we brought down a balance from the previous year of 2,800. Now we've provided for an additional 6,000 rands. So our liability at this point in time on this account is 8,800 rands, and it is a credit balance. So that means we owe it to the revenue service. They are creditors of ours. So if we are going to settle the amount outstanding, it means we have to pay them 8,800 rands, right? We make a payment, so we need to credit our bank account. We no longer owe the money to the revenue service, so we debit the current tax payable income tax account. And then at this point in time, before we start the next cycle, the 2020 cycle, it means this account now has a zero balance. No amount outstanding on either side. And then the cycle starts again. We make our first provisional tax payment on the 30th of June, 40,000 rands. We make our second provisional tax payment on the 31st of December 2020, 52,000 rands. Sometime in the following year, when we are going to finish our financial statements for the 2020 year, we have to again estimate our income tax expense, because we need that as a line item on the face of our statement of comprehensive income. We have to calculate what we believe our taxable profit will be. It was given in this question as 320,000 rands. We apply the applicable tax rate of 28%, which gives us an amount of 89,600 rands. Right. Now we've got to accrue. We've got to accrue that expense, which means we've got to debit the expense, the income tax expense account with 89,600, and at the same time we have to raise the liability towards the revenue service, which means we are going to credit current tax payable income tax with that 89,200. Okay, now we can complete our financial statements. We can complete our tax return. We can submit the tax return with our completed financial statements to the revenue service, and then we can await their assessment. So that is the end of that financial year for us, except perhaps we might make an adjustment for an over or under provision, but only next year. So for this cycle it is done. So we're going to close off the account. We're going to see that we have a balance that we are going to carry forward of 2,400 rand. Just an interesting thing. This is basically more for financial accounting 3 purposes, but I'm sure financial accounting 2 students will also be interested in this. We saw that our under provision for the 2019 year was 6,000 rands. But what was our underpayment? Was it 6,000 rands? No. How much did we pay once we've corrected for the under provision? We actually paid 8,800 rands. Right? So our underpayment for the year was 8,800 rand, even though our under provision was 6,000 rands. Well, there's another way that you can look at the underpayment as well. How much should we have paid for the total expense for the year according to the Revenue Service? They provided us with an assessment that said our total expense is 78,800 rands. How much did we pay? We paid a first provisional tax payment of 30,000. We paid a second provisional tax payment of 40,000, which gives us a total of 70,000. Right? But they say our total expense should have been 78,800. So what did we underpay? We underpaid 8,800. Right? But we already had that 2,800 balance that we've carried forward from the previous year. So we only needed to provide for an extra expense of 6,000 rands to then give us this balance of the underpayment on the account of 8,800 rands. In the income tax expense account, there we will find the contrast to those entries that relate to the income tax expense account in the current tax payable income tax account. So we can see the 2019 year where we provided for an income tax expense of 72,800, and then when we closed off that account at the end of the year, we would have transferred that account to the profit and loss account. In the following year, we must remember that we made an adjustment for the previous year's under provision, but in the current year, right? So we provided some more income tax expense for the previous year. That is what that 6,000 rands represents. And then at the end of the year, we provided for this current year's income tax expense of 89,600. So that means the amount that we are closing off to our profit and loss account will be 95,600 rands. Now this should already make us think a little bit about our income tax expense note, because clearly in this second year, this 2020 year, we are closing this account off to the profit and loss account to the value of 95,600. So clearly on the face of our statement of comprehensive income, we're going to have an income tax expense of 95,600. But of that 95,600, 6,000 related to the prior year, not this year, the prior year. And only 89,600 rand relates to the current year. So clearly there's got to be a way that we are going to explain that to the users of the financial statements in our income tax expense note. There we've got some comments on those general ledger account entries. When you go to the slides with no sound, you can take your time. There are cross references. You can see there's a reference 1, 2, 3, 4, 5, 6, and so forth from the solutions in the previous slides, and then they provide you with what it means, right? So those are cross references between your answers and the comments. In the income tax expense note, we're only going to look at the 2020 year. The 2019 year you can do very easily. In the 2020 year, as we've already alluded when we had a look at the income tax expense account, we know that the total income tax expense, the amount that we have closed off to our profit and loss account, is 95,600 rands. But that was not the income tax expense only for this year. We've got to explain now to the users, what does it consist of? What does the income tax expense consist of, as we've said earlier? Right, it consists of two items. The current tax for the current year, this financial year, of 89,600 rands, but also current tax, not deferred tax, current tax, that was underprovided in the prior year, last year. So the reason we've got an expense of 95,600 in our statement of comprehensive income is the 89,600 income tax expense for this year, but the additional 6,000 rands as well that we had to provide this year, but that related to last year. Last year we underprovided. The second part of the note, where we have the rate reconciliation, we have already discussed what it means. We've got the applicable tax rate. Then we are going to repeat our tax calculation, but we said there's one exception. The exception is when it comes to an over or under provision. When there's an over or under provision, we've got to include this in our rate reconciliation note, because it does affect the effective tax rate. So we had a profit before tax, that is where we started our tax calculation with the accounting profit of 89,600. In this example, there were no permanent differences, so we did not make any adjustments, but we must remember that we did have an additional tax expense this year relating to last year. So that increases our tax expense, and that will clearly increase the effective tax rate. So anyway, the tax effect, we are going to do our normal tax calculation, but only provide the tax effects, but we also add any under provision, or we will deduct any over provision that we now have adjusted for in this current year, and that will then give us the income tax expense that we disclose on the face of the statement of comprehensive income. Here we can see the effective tax rate is more than the applicable tax rate. And why? Why? Because we had to increase the income tax expense relating to last year, but we had to include it in this year's expense figure. Right. Now let us have a look at the calculation of the first and second provisional tax payments. When it comes to the first provisional tax payment, the one that needs to be paid on or before the last day of the first 6 months of the year, the company needs to estimate what they believe their taxable profit for the full year is going to be. But now we must place ourselves in that situation. Let's say the company's financial year ends on the 31st of December. Now they are only halfway, not even halfway through the year. They're somewhere in June, towards the end of June. So they only have complete records for the year for maybe January, February, March, April, and May. Okay, so it is an estimate. But anyway, they have to estimate what they think the full taxable profit for the year will be. Then they've got to apply the applicable tax rate to that amount, 28%. That will be what they believe their taxable, their income tax expense for the year will be. We are halfway through the year, so we divide it by 2 to make the first provisional tax payment. At the end of the year, just before the end of the year in December, if they've got a December year end, they probably only have complete records, let's say up till the end of November. So they again have to estimate what they believe their taxable profit for the full year will be. And again, they have to apply the applicable tax rate of 28%. Once they've calculated that provides them what they believe their income tax expense for the full year should be. And then, in this case, when they make the payment, they deduct whatever they have paid as a first provisional tax payment and pay over the balance to the Revenue Service. Let's look at an example of that. Again, our company is X Limited. We've got a year end on the 31st of December. Our applicable tax rate for both years is 28%. Then we have some information what took place during 2019 and 2020. On the 30th of June, we see that the taxable profit for the 2019 year was estimated at 214,285 rands. Consequently, the first provisional tax payment was calculated and paid, right? So we'll have to go and calculate what it was. On the 31st of December, at the end of the year, they recalculated, they re-estimated their taxable profit at 250,000 rands, right? So they have a better second 6 months than the first 6 months. And then consequently, the second provisional tax payment was made and calculated based on that revised estimation. And then also on the 31st, the provision for the income tax expense was made, and we see here both the profit before tax and the taxable income were calculated at 260,000 rands, right? The profit before tax, as we know, represents our accounting profit. Taxable income is the taxable profit, so there's no permanent differences or temporary differences for that matter. What else? We received the tax assessment from the South African Revenue Service, and they tell us that according to their calculations, our assessed tax for that 2020 year was 71,800. Then on the 15th of February, 2 weeks later, the amount payable to the Revenue Service or refundable by the Revenue Service was settled. Well, we'll have to go and see once we've made that adjustment whether there's a debit or a credit balance on the account. On the 30th of June 2020, we again estimated our taxable profit for the year at 250,000 rands. In fact, very often they use the previous year's taxable profit as an estimate for the next year's first provisional tax payment. On the 31st of December, they revised that estimate, so they see that they had a better second 6 months again than in the first 6 months, so they revised it upwards. And then at the end of the year, they had to provide for the income tax expense, and we can see again that there were no permanent or temporary differences for that year, so the accounting profit and the taxable profit was equal to one another. So what is required of us? First of all, calculate the first and calculate the second provisional tax payment for the 2020 year, so from the 1st of January 2019 till the 31st of December 2020. In fact, that is 2 financial years. The financial year ended the 31st of December 2019, as well as the financial year ended the 31st of December 2020. Got to show the following accounts for those 2 years: the income tax payable income tax account, in other words the liability, and the income tax expense account. Then we've got to disclose the income tax expense note for the year ended the 31st of December 2020. So we can see this example is similar, what is required of us, to the previous example. It is just that there are different figures and different facts. So how are we going to calculate the first provisional, second provisional tax payment? How are we going to provide or estimate our income tax expense? So let's look at the 2019 financial year first. So halfway through the year, we have estimated that our accounting as well as tax profit for the year, the full year, is going to be 214,285 rand. So we apply the applicable tax rate of 28%. That then gives us 60,000 rands. Being at the halfway stage, we only pay over half the amount that we believe we will owe for the full year. So that gives us 30,000 rands. At the end of the year, when we have to do a second provisional tax payment, we've got more complete records. Now we don't only have the first 5 months financial accounting records. Now we've probably got 11 months, so we've got more accurate records. Now we can see that the accountant has estimated that the taxable profit for the full 2019 year is going to amount to 250,000 rands or thereabouts. And then he or she applies the applicable tax rate of 28% to that, which then gives us what they believe is going to be the full amount that they are going to have as a tax expense for 2019, and that amounts to 70,000 rands. Now they've got to pay over the difference between what they've already paid halfway through the year and what they feel their total income tax expense for the year will be. We've seen that they've calculated that their belief is that they're going to have a complete or a total income tax expense for the year, the estimate at the end of the year of 70,000 rands. They've already paid over 30,000 rands at the halfway stage. So to top it up at the end of this year for the second provisional tax payment, they've got to pay in an additional 40,000 rands. You can do the same calculations when it comes to the 2020 year. Remember, at the halfway stage, they simply use what the full estimate for the year's taxable profit is going to be, apply the applicable tax rate, pay half of it. At the end of the year, they again look at what they believe the full taxable profit for the year is going to be, apply the tax rate to it, but now they don't pay over half, they pay over whatever is the difference between what they feel is the total tax expense for the year and what they've already paid over at the halfway stage. And here we have the various accounts, so that will be very similar to what we had in our previous example. One thing that you must remember here is that we had an over provision. In the previous example, we had an under provision. So here on the 1st of February, we have to decrease the income tax expense relating to the previous year. But the same principles apply. Remember, there you've got the numbers cross-referencing this slide to the slide that explains what it means. The same with the income tax expense account. And there we have the notes that cross-references to the previous two slides. And in this case, we look at the income tax expense note. We see, like we've mentioned before, there was an over provision in the previous year. So when we show this part of the note, the over provision is going to be a negative. Why is it going to be a negative in this year? Because last year we provided too much tax. So this year we've got to provide less tax. But that less tax relates to last year, even though we can only record it and disclose it this year. So that means the amount that we over provided last year needs to be decreased in our expense this year. The second part of the note, the rate reconciliation, once again bear in mind that the over or under provision will have an effect on the effective tax rate. So that must be included in there. Thank you so much. That covers the income tax part. We are next going to look at dividends tax. We are also going to have a look at capital gains tax as part of this topic. Also remember that you now can have a look at the slides without the sound. That you can do in your own time. So you can go upwards, you can go downwards. The slide will stay there until you either press the space bar or page down or page up. All the best.